Managerial Accounting Example 4A. Please read and become familiar with the example, and we'll begin. So this company is considering dropping the consumer division. Now the division has been unprofitable, and as it says, there's no sign that the profitability will improve anytime soon. So we're trying to consider what would happen if we drop it. Now, dropping a division often seems like it's going to be a pretty cut and dried decision. We look at it and we say, hey, we're losing $45,000. If we drop this division, we'll stop losing that $45,000. We'll be $45,000 better off. Unfortunately, it's not always quite that simple. A lot of the costs that are going to be reported in the income statement of this division are not necessarily costs that are going to change as a result of dropping the division. There are also some things that are in other columns of the income statement, other parts of our business that may be affected by this change. So we have to think a lot more carefully. Accounting income statements don't always give you the specific information that's relevant for a particular decision. They're generally designed to be a general purpose financial statement. They're not always intended to be used for a specific purpose you might want to use them for. So we have to be careful. So let's take a look. What happens? We currently have this loss of $45,000. In examining the decision, management has found out a few things. First of all, we can fire 8 employees and we can stop some marketing efforts, so we can actually save real $80,000 of fixed costs. Another portion of our fixed cost is depreciation. And these are assets that we've bought. Remember what depreciation is. Depreciation is allocating the purchase price of an asset over the period of time that the asset is going to be used. The cost that we're depreciating is actually a sunk cost. We incurred that cost a long time ago when we purchased the asset. So we can't go back and undo that. We can't go back to the people we bought the asset from and say, hey, we've decided we don't want it anymore. Take the asset back. Give us our money back. We can't do that. We might be able to sell our assets on a used asset market. There might be a market to sell these things, but that doesn't undo the cost that we originally paid. No matter what we do going forward, we still have to deal with the fact that we paid the original purchase price of the assets. We have some of our fixed costs that won't be affected at all. A lot of the office space and some of the same administrative staff and things that the consumer division uses are shared among consumer, governmental, and commercial. And so the cost of those things are not going to be affected at all. And then finally, this is what I mentioned before, there are some things that affect consumer that also affect other parts of the business, and we have to consider those. Here we find out that dropping the consumer division would cause us to lose about 5% of our sales in the commercial division because they share some common customers who would be disappointed and would find somewhere else to do some of their business. So we've got to take a look at this and figure out what the relevant costs are. Remember that a relevant cost is a cost that changes as a result of a decision that you make. So the relevant costs are going to be any cost information that changes as a result of dropping the consumer division. What happens if we drop consumer? Well, the first thing that's going to happen is we're going to lose our sales. So we're going to lose $350,000 of sales revenue. We're going to save our variable costs. So we'll put that in as a positive. We're going to save 185. Pardon me. Forgive me for my typos. We're going to save $185,000 of variable cost. So if we put these two together, we're really going to lose a total contribution margin of $165,000. That's the amount by which we'll be worse off for having dropped the consumer division. That's not all, though. We do get to save some fixed costs. So in this case, we're told we're going to save $80,000. So we'll put that in as a positive because income is going to go up because we save that money. The depreciation, we're not going to save that. Like I said, that's a cost we've already incurred. Our accounting system reports that in future periods as we depreciate the asset, but it's a cost we've already incurred. And we're not going to save any of the other expenses that we have with our shared resources, because government and commercial are still going to use those. The last piece of information we have that we can consider is what happens if we drop consumer, what happens to commercial? Well, with commercial, we're going to lose 5% of our sales, so equals 0.05 times $610,000. So we're going to lose that much in sales. We're going to save commercial variable costs, equals 0.05 times $210,000 of variable cost. So we're going to lose commercial contribution margin of $200,000. Sorry, $20,000. So in this decision to drop the consumer division, we lose $165,000 of consumer's own contribution margin. We only get to save $80,000 of fixed costs. The other fixed costs that are reported here are either costs that are common across our three divisions that aren't going to change, or they're sunk costs that we can't undo. And on top of that, we also lose $20,000 of commercial contribution margin from the other division. So the net change in NOI, or the sum of all of our relevant costs, is a reduction in net operating income of $105,000. So even though it looks like we're going to save a $45,000 loss, turns out we actually lose $105,000 of profitability. That's our change in net operating income. Our current company net operating income is the $247 that we show right here. So our new quarterly net operating income would be $247 minus 105, and it would be only $142,000, which is not better than where we currently are. Another way to put this is that even though the consumer division looks like it's showing a loss, it really contributes $105,000 of net operating income to the overall business, partly because it supports $20,000 of the total contribution of the commercial division, and partly because it creates enough contribution margin on its own to cover the fixed costs that we would save if we got rid of it. So even though consumer looks like it's losing money, we're better off with it than we would be without it. Now, how can we get it to start making more money? Well, certainly we could increase sales, we could reduce costs, we can try to market more effectively. The fact that we don't drop it, or the fact that dropping it would cause us to lose income, doesn't mean we leave it alone. It just means we have to be very careful to recognize that dropping it doesn't make us better off.